Would you please welcome to the stage your host, Steve McKnight.
Thanks, Andrew. Good morning, everyone, and welcome to Conference 2012. Now, I've had my 40th birthday since Conference last year to this year, and my little girls took me out to David Jones, and they said, "Dad, you're now 40, you've got to wear a hat, and you've got to wear a scarf." All right, so I can at least tick the box and say that I wore the hat and I wore the scarf on stage, and now I can take it off. If you haven't already done so, can you say hello to someone sitting next to you or near you? We're all friends over the course of this weekend. Give them a big high five. Welcome them along. Now, there are about 1,050 people who will be coming this weekend. Friday morning's always the slower point of the weekend, and then it builds up steam, builds up steam, builds up steam. So there's still about 100 or 150 people upstairs, I'm told. So if someone's trying to squeeze past you, maybe fill up the gaps in the middle if you can. All right, the keynote that I'm going to deliver now is going to go for around, it says 60 minutes there, it's actually going to go for 90 minutes. I'm going to talk to you about formalities and structure of conference. Can I just see who's here for the first time? Oh, wow. Okay. Then I'm going to do a market update, give you a quick idea of what's happening in the Australian property market at the moment. Then I'm going to talk to you about from zero to financial freedom and the two-step model that I recommend you follow to achieve financial freedom, particularly if you're starting today. Then I'm going to do a quick wrap-up and then introduce our next speaker, which is Tom Ziegler from the United States of America. So you guys being here live to see Tom speak is going to be an event you're probably going to remember for the rest of your life, so that's pretty exciting. But first, something really special has happened. Hot off the press yesterday, and included when you registered, if you registered, is this little puppy. And it's been a big dream of mine for a number of years to try and help people who just haven't got into the property game. And over many years, people have said to me, "Steve, can you invest my money for me?" I've always said, "No, I don't do that. I strictly teach people how to do it and do my own investing." Anyway, I see and have seen for a couple of years now an amazing opportunity about investing in the United States of America. And at a conference 2 years ago, I talked to people about that. And over the last 2 years, I've made a lot of money out of investing in the United States of America, basically doubled my money in 2 years, which is pretty amazing. And I see the window of opportunity to make money closing as the US economy is improving. I mean, we've already seen our dollar go from like $1.07 down to 97 cents. You know, this opportunity is only an opportunity that's going to be around for a short time. So in a nutshell, what I did is I went away and ticked all the necessary legal boxes to create the first ever pooled managed investment fund to go and buy commercial property in the United States of America that's run by PropertyInvesting.com, or run by me. So it's pretty exciting. So I think that deserves a round of applause, even if you have no idea of how much effort's gone into it. The thing I love about this is that it's an opportunity for you guys to get paid to learn, because the idea is that you invest in the fund if you're interested and read the PDS, and then we do biannual meetings. So every 6 months we get together as a group of unit holders and we look at the properties that have been acquired, look at the properties that we're looking to buy, and effectively run a seminar around those properties to teach you about investing using what you're learning in the fund. So to me, it's a tremendous opportunity to do two things that I love: help people make money and teach them at the same time. So there'll be more information about that during the course of the event. 7th of May, in the news, RBA forecast, rents to rise, house prices not. 2 years ago, Reserve Bank Governor Glenn Stevens gave punters a very public warning not to bet on house prices rising. It turned out to be good advice. Now the RBA is pointing to, and this is the real key, housing remaining subdued until lower purchase prices. There are three things. First one is, say it with me, lower purchase prices. Now, in order for there to be lower purchase prices, what has to happen to house prices? Yeah, they need to go down. Right? Lower house prices, higher rental yields, and the third thing, population growth. Now, people say to me, Steve, how do I know what's going to happen to the property market? How can I predict it? And, the gag is my head's getting shinier, but it's not a crystal ball yet. But what you can do is you can look at the media and get some idea of how the factors are shaping up that affect the property market. And the three big ones, according to the RBA, are... All right, it's not rocket science. Number one, lower purchase prices. Number two, higher rental yields. And number three... All right, good. The second article I want to talk to you about is one that came out this morning. So we get the latest information here at conference. Interest rates tipped to hit record low as economy splutters. Now I want to say that again with a bit more of a dramatic voice. So first of all, can you gasp in shock for me? Righto. So I want a gasp of shock when I'm finished. And we've practiced once already. So interest rates tipped to hit record low as economy splutters. Westpac's most senior economist expects the official interest rate set by the Reserve Bank will fall, check this out, will fall to its lowest level on record. Can I have another gasp? You're getting the hang of this. Lowest level on record by the end of the year, as global woes and falling consumer confidence stall the local economy. There's some good news for you. Westpac Chief Economist Bill Evans, who last year correctly forecast that the central bank would slash rates this year, said the official cash rate would drop as low as 2.75% by Christmas, and standard variable rates on mortgages would fall to about 6%. If we go back to the other side of the slide and we said the RBA is now pointing to the housing remaining subdued until lower purchase prices, higher rental yields. As interest rates go down, what happens to rental yields? All right, so you can see how these things are now connected. Now, the top 5 indicators that I look at when I look at the property market are median house prices, jobs and employment, housing finance, housing approvals, consumer and business sentiment. And we're going to spend a couple of minutes now just looking at each one of them. First of all, median house prices. Now, here's the bummer, all right? The next RP data series, which is what these median house prices are based off, comes out at like 9 minutes' time. So I can't build them into these slides, but when I come up at the end of the day, I'm going to do an update to show you what's happened over the course of today. Would you like that? It's not an easy thing for me to do, to sit there and prepare slides on the fly, but I thought it'd be worthwhile for us to look at it as it was in April and then come back at the end of today and look at it as it is in May. What do you think? Yeah, I think so. So this is as at the end of April, which is now 1 month old. And this is the RP data index as at 30 April 2012, and there's a lot of information for you to take in there, so I've summarised it for you. And we've got these little races that happen. Now, apologies if you don't live in Perth, Sydney, Melbourne or Brisbane, but I've just taken the big cities because I've only got so much room on the slide. And we're all lined up at the start line, and we want to see which house wins. Now, if we were betting, who do you think has performed the best? All right, hands up Perth. All right, hands up Sydney, Melbourne, Brizzy. Yeah, all right. And they're off. And the least bad performing is Sydney. So that means that Sydney won, sort of. And the worst performing city was Melbourne, down 7%. So that's year on year. And if we look at how the various cities perform now, including others, you can see that it's a tale of woe across the board. But, you know, I used to be reasonably overweight as a kid, and my sister used to like to pick on me. And one year she got me a t-shirt that said, "If you want to feel thin, hang around with fat friends," which I always thought was a bit harsh. But if you want to feel good about the Australian property market, take it in context with what's happening in the world. United States, Europe, and all of a sudden these, even though they're negative, they're not a disaster like is what's happening elsewhere. But you know you're in trouble if the most positive thing you can say about the property market is it's not as bad as somewhere else. Can you still make money? Yeah. It's just that the general trend, the generic picture, if you like, is heading slightly downwards. All right, so we've looked at year on year. Let's look on quarter, shall we? Ready, set? Let's try that again. Ready, set? Hardly inspiring. It barely got over the line, that's right. Look at that. Interestingly, now Melbourne over the last quarter hasn't performed so badly. And then if we do one more race and we look at month on month, how do you think it's going to work out? Again, hardly inspiring. What it shows me, though, looking at the three of them together, let me try and make sense of the tea leaves for you, is that the three of them together point to the housing market contraction slightly slowing. And one of the main drivers for that is interest rates coming down. It'll be fascinating to see what's happened over the last month tonight. So make sure you hang around for 9 o'clock so you can see what the story is. I'm fascinated to see as well. I think you'll find that the decline is still a decline, but again, it's easing rather than accelerating. What do you think falling house prices will do to the property market? Stimulate it? Okay, so what falling house prices or what falling interest rates does is that it makes renting more expensive than home owning. All right, so the rents are going up and the interest rates are coming down, and so those people who are renting suddenly start thinking maybe it's a good time to go and buy. So the margin between what it costs to rent and what it costs to buy, as that squeezes, the property market finds support. All right, second thing I want to look at, jobs and unemployment, because one of the big drivers of real estate prices is jobs. And we see daily in the paper news of more places effectively closing down, and this week has been no exception. But if we look at the unemployment rate in Australia, it's reasonably stable at 5.1%, which is at historic lows. So although there are lots of jobs being shed, there are still lots of jobs being created. If we see unemployment spike up, that will be a cause of concern for house prices. In regards to housing finance, the reason why I look at housing finance is because if more people are out there borrowing money, it's indicative of action happening in the property market. Unfortunately, housing finance is slowing down. If we look at the percentage changes up there on the screen, most of them are negative. And that to me is symptomatic of when people don't know what to do, they do nothing. And so the market just ebbs and flows a little bit. Next thing I want you to look at is building approvals. In America, one of the reasons why their housing market crashed, particularly in certain states like Florida, is because they were building a whole lot of homes. They had this building boom going on, but they didn't have anyone to live in them. In Australia, we have a really unusual situation in that we are basically not building enough homes. And the reason why we're not building enough homes is because developers are struggling to get finance and making money out of building. Write down this word, absorption. All right, this is a good word to know. The notion of absorption works like this. Let's say that on any given Saturday, there are 1,000 auctions. And so every week there are another 1,000 auctions. And in week one, only 500 properties sell. So in week two, there are 1,000 auctions and another 500 properties that carry over into week two. In week 3, there are another 1,000 auctions. And how many houses are there now? 1,000 houses. And then the next week, there are 1,000 auctions, and now we have 1,500. So monitoring what's happening with absorption rates is very important because it gives you an idea, not about auction clearances, that's not so important, but the idea of how many houses are being absorbed is critical. And right now, the absorption rate is not looking good. So there are more houses, it's not more auctions necessarily, it's just fewer buyers at auction forcing those houses into the absorption phase, needing to be tidied up. Now, what would compound the absorption problem is a whole lot of houses being built. Let me just cut to the chase. In Australia, we don't have a supply glut problem. And because we don't have a supply glut problem, the chances of there being a crash are mitigated. Yes, we can get a decline, the brakes can come on, but the idea of property prices falling by 25 or 50% is remote. And so that gives us confidence as investors to a certain degree. The last thing I want to look at quickly in regards to a market update is consumer sentiment, because when people are optimistic, they tend to spend money. When they're pessimistic, they don't spend money. And in Australia right now, the pessimists are winning. So the index is under 100. This measures percentage change, but we're on the wrong side of it. We're about 98. If we look at business sentiment is positive. Business sentiment feeds into jobs. So if we have good consumer confidence, people out there spending, and we have good business confidence out there employing, then there'll be a lag, but it'll feed into house prices. What does this mean? It means, everything else being equal, I totally agree that the status quo is going to continue, with house prices not booming, not crashing, just ebbing slightly positive, slightly negative, except in a couple of spots. So when we look at, generally speaking, I like to weigh the upside and the downside. And we start with the bad news first in regards to the downside. We have this economic malaise which has sort of set into Australia. If you go to Chris Lang's presentation, I'm assuming one of the things Chris is going to say is that Australians are saving a lot of money at the moment. And one of the things about saving money is that you save money to eventually do what with it? Spend it. So Australians are hoarding cash, even paying off debt, and that is the rocket fuel that will eventually, when things change and people feel more positive and salaries are going up, that'll be the rocket fuel into the next major increase in house prices. But it's not going to happen anytime soon. When you add this economic malaise, people feeling uncertain about their future, so they save instead of spend, with political instability, which is what we've got in the federal government at the moment, and you add that to this carbon tax that no one really understands what's going to happen, but actually comes in 3 weeks' time. And then you add that to a high Australian dollar, which is killing tourism and retail. And you have a situation where people are feeling pretty pessimistic rather than optimistic. And if we go to the upside, really the only upside for the housing market is lower interest rates, feeding through to increased affordability, and this notion of increased savings that I was talking about. So what's the conclusion? Well, things are recovering in Perth, and for those of you who have made the trip over, the people that I talk to in Perth are saying that house prices have started to shoot up reasonably significantly. Properties that they couldn't sell, they're now getting 2 and 3 offers on. Prices haven't doubled or gone anything silly, but there's now action happening in the Perth property market again, which is good because Perth took a long time to recover. Brisbane's stabilising. There hasn't been a flood or a cyclone of any significance for the last few months, so Brizzy's coming good. We're flattish elsewhere, particularly Melbourne and Sydney, which are the 2 biggest drivers of the housing market. Why? Because that's where most of the media is. So if something good's happening in Melbourne and Sydney, they just believe it's happening everywhere, even though it's not necessarily. And in my opinion, it's likely to remain this way for the rest of the year. Some of you may have seen me do this before, but it's a good illustration. Generally speaking, if this is the property market, and this is price, and this is time, what happens is that the property market, as you can see on the screen in front of you, trends up over time. And that's caused by inflation and population growth, and so generally speaking, property prices trend up. That's quite funky to have me up there on the screen like that, I must say. But at any point in the market, we have points where it goes above and points where it goes below. Just the normal ebb and flow of the market. Now, in my opinion, these are points of volatility. Imagine the property market like an elastic band. It has its own shape and its own form, but from time to time there are factors that cause the property market to stretch out of shape, such as a first homeowner's grant or something happens into the market causes it to stretch out. But when that factor is no longer present, what happens? It snaps back into its normal shape. So if we look at a mining town like, I don't know, somewhere in Queensland, Moranbah, that's going through Dysart, some of these type areas, it's going through a big boom. If we took the reason for that boom out, what would happen to the housing market? It'd probably snap back into shape because the volatility on the upside has pushed it way above where it probably should be if that factor is no longer present. And so what that teaches us, that when it comes to real estate, we want to get into the market and we want to get, starts with out. We want to get into the market and we want to get out of the market before the conditions change. Because once the conditions change, then the market may snap back into shape. And so it doesn't matter where you are in Australia, what you want to be weighing up is what is happening to the property market. So let's look at this again for a second. When I went to the United States a couple of years ago and started buying up duplexes for $12,000, these things used to be worth over $100,000 and they fell in price to $12,000. That's not each, that's $12,000 total, $6,000 per property. The market had come down to here. It had come up and it had gone down. And I thought, wow, when the conditions no longer exist, the thing that's most likely to happen is what? It's going to snap back into shape. The only problem is you don't know when it's going to happen, all right? Yes? All right, so there's no certainty about that, but you can say that the property market has a certain shape and look to it, and if you can invest, either keep going up while the conditions there, or if you see an opportunity down here that you can take advantage of, that's how you can achieve above market returns. So looking ahead, low interest rates, property prices going down, to me, there's a risk that property prices will drop below that line. And so when these conditions no longer exist, prices can snap back up reasonably quickly. And that's your opportunity to make quite a large amount of money in quite a quick period of time. We're going to have these pent-up savings. People want to invest. They're going to want to do something with it. So there's going to be a lot of money back in the economy when things change. Affordability for a short window will be good and then it'll start going down again. We'll keep having these low building approvals until developers can make more money. And all this, in my opinion, points to a reasonably rosy recovery at some point. But there may be a pause between now and that recovery. So where's the opportunity? It's a question I always ask myself. This is all good, it's all interesting. In fact, in some ways it's fascinating, but how can I make money out of it? Well, you're one of two investors. You're either a generic investor, so you're making a generic gain by just buying and waiting and seeing what the market does. So as the market goes up, you go up, and as the market goes down, you go down. Most people who buy and hold are what kind of investors? Speculators. They're after a generic profit, whatever the market gives them. And so in the current market, if you are a generic investor with interest rates going down, it's the return of positive cash flow property. And that's what I'll be talking about in my workshop, Brilliant Buy and Holds. I'll be running you through my 1% rule, showing you some examples of properties which are now positive cash flow. And as in... Oh. Okay. Didn't I say that are now... Oh, I did say those two words, that's right, well done. Gotta be careful what you say. So, if you are interested in getting a situation where you have more cash in your pocket than going out of your pocket, then lower interest rates are going to be good news for you because more property will meet the criteria, particularly as you see how this 1% rule works. Or alternatively, if you're a growth investor, look to these emerging markets, the Perth market, the Brizzy market, that kind of thing, because that's where the trend is your friend, rather than in Sydney and Melbourne, where it's becoming a bit tricky. If you're into manufactured profits, that means you're using your skill as an investor to outperform, then that's okay. Just do your sums very carefully, because you may find the property market slips between when you buy and sell your reno or when you buy and sell your development. So what's the conclusion? So long as people live in houses, you can make money out of property. That's true. There are people who need to buy and there are people who need to sell. In my workshop, which is later on during the conference, and in it I talk about turning procrastination into profit. For those of you who can't make that workshop, I'll tell you one of the key themes in it right now. Just as there are unproductive people, there are also unproductive properties. And if you know how to find those unproductive properties and you know how to fix them, then that's how you can make money. And so right now, there are great deals everywhere. In fact, there are more great deals now than there are when the market's booming, because there are less people buying them. If you can get clarity on your strategy, if you can get clarity on what you're trying to do, now is a fantastic time to be investing, because you can negotiate. You can't negotiate when the market's going really well. People aren't interested. It's a crying shame that most people want to buy when the market's doing well and want to sell when the market's doing badly. Did anyone get dragged along to this thing? They didn't really know what they were coming for, and yeah, I feel the same way. Now, does anyone not know who I am? I won't be offended if you've never heard of me before or anything else like that. Yeah, good on you, Chris. All right, just in case you're too shy to put up your hand, let me give you a 5-second synopsis of the Steve McKnight story. I was a boring accountant. Secret handshake to all other accountants in the room. I thought the secret to being a happy accountant was to start up my own practice. So I went from being an employee to being a business owner in 1999. And after about 2 months of doing that, I realised that being the owner of an accounting practice was no better than being an employee of an accounting practice, for one simple reason: you were still doing accounting. And so I realised that if I wanted to be happy, given that I had a whole lot of life ahead, I needed to do something different. There was no point staying doing accounting. And I went to a seminar run by a guy called Robert Kiyosaki, and many of you know the name, have read the book. And at the seminar, there was a real estate agent from Sydney who got up and said, I don't know why people buy negatively geared property, and I knew all about that being an accountant, when you can buy positively geared property. And I'm like, well, what's that? I've never heard of positively geared property before. And as he explained it, I thought, wow, I wonder if there are these things in Melbourne. And as I thought about it some more, I thought, wow, if I could own enough of these things, I wouldn't have to work as an accountant anymore. And I went on a little mission, a quest, if you like, to go from zero, because that's what I started with, to as many properties as I needed in order to be financially free. And it took 5 years to have enough money not to ever have to work as an accountant anymore. The book says 3.5 years, but there were 2 of us. Right? So north of 130 properties in 3.5 years. It was all done and dusted by 5 years. So I literally, with my business partner at the time, Dave Bradley, went out and bought hundreds of properties. And people say, how did you do that? And to this day, I don't know. It was like a miracle. We started off with vendor finance and we kept buying these properties, and we sold some along the way, and we just kept buying and buying properties. And then it struck me that 2 years ago, I started buying properties in the United States. And I'm up to over 200 now. And I thought, I've done it again, and I didn't know it. It's amazing. As you make a plan and you enact the plan, you get going. So I'm the guy who was so dumb that I stayed with accounting for 12 years because I didn't know any better. And one day I woke up and I thought, I can't do this anymore. I've got to find a way to get some money. And real estate's how I did it. Is there anyone else in the room who is sort of like me? Not necessarily an accountant, but is stuck doing something you don't want to do? If so, then this presentation is for you. It's titled From Naught to Financial Freedom. How to do it again today. Conceptually, if you're not happy with the way that your financial future is panning out, you need another system. You need another approach. It's a bit like a computer program that boots up every day according to the software program that's on the computer. So every day you get up, you are programmed. And if you don't like the way that your daily program is working, you need a what? You need a new program. It's not rocket science. And the program that most people have is that they start the day with earned income and they end the day with earned income. And then they get to the weekend and they spend. And then they start up the next day and so on and so forth. What we need to do is we need to break the model. So we need to get off the addiction of earned income and move into growth assets, and then eventually after we've hit our targets with growth assets, we want to move into passive or investment income. All right, here's the first aha moment. It's likely, almost certain, that you're addicted to earned income. Because you need it to live. It's the air that you've got to fuel you at the moment. But your future is not in earned income. Do I get an amen anywhere? Amen. All right, so your future is not in earned income. So the program that you are playing is not going to deliver the outcome that is relevant to you. You need a new program. You cannot continue to play the earned income software program and expect to achieve your financial goals unless you're already achieving your financial goals with what you're doing. It just won't work. The earned income model is you take little bits of money for big slabs of time. And as we transition, we want to move into the middle, which is little amounts of money for little amounts of time, and we want to end up getting paid big amounts of money for little amounts of time. And the question is, how? You probably don't need me to convince you on the merits of this. Sign me up, Steve, I'm in. But how am I going to do it? All right, I need you to work on something. So you need to get a pen and a bit of paper. All right, first thing I want you to do is I want you to nominate, everyone in the room, I want you to nominate an annual amount of pre-tax income that you would like to earn. Don't be greedy. Just set the expectation at realistic. If you could have this much per annum, how much would you want? And if you have no idea, because you've never thought about this before, just put down the amount that you're earning at the moment in your job. Because if you could replace that money with investment income, you'd be financially free. You may not have a yacht and a Ferrari and a full head of hair like me, but you will be financially free. You won't need your job anymore. Has everyone got a figure? Yep. Just at a guess, who wrote 100,000? Interesting. All right, then what you need to do is divide that by 0.8. So you may have to pull out your phones here or your calculators or whatever you've got, share it around if you're amongst friends, and I want you to divide that by 0.08. Can you do that for me? You just go 100,000, if that's your figure, divided by 0.08. Anyone got an answer? Righto, Andrew. What was can I ask you what your income was? 400,000. 400,000. Here's a man who has some ambition. And so what's your sum that you need? $5 million. You need $5 million. If Andrew could have an investment portfolio of $5 million and it had assets in it that were earning 8%, he would achieve his goal. Andrew's mission is to do what? Number one, get how much worth of assets? $5 million worth of assets. And number two, those assets have to be earning what? 8%. Anyone else got a number for me? Come on, brave so. 120,000. Well done. And what's your asset base required? $1.5 million. So if, turn your name tag around. If Wayne could get $1.5 million worth of assets at 8% return, he would achieve his goal. The biggest reason, in my opinion, why people fail is because they don't know what they're trying to do. They have no context for their wealth creation, so they can always have more. They never know when enough is enough. So right now, you've set the goal. If you can achieve this much in assets, earning 8% per annum, then you will have your income goal. Does everyone have a target now? Yep. If you don't have a target, then do the maths before the end of this session. It's important you walk out here with a target. The last thing you need to do is write down a date you want to have that achieved by. Can you do that for me? Got a date? The question you're thinking is, this is great, but starts with how. How am I going to do it? It's a good question to ask. You're lucky, I'm in the how business. Now, just to give you some idea, a dose of reality. Right now, if you want to survive on the aged pension and you're a single, then you're going to have to live off $18,000 a year. To live a modest lifestyle, assuming you own your own home, you need $21,000 a year. And if you want to live like a really rich person, $40,000 a year. That's probably much less than the figures you wrote down. Yeah? I've got a slide in one of my presentations that says roughly 70% of people living alone report in the last census that the aged pension was their major source of income. Gasp of shock? Think about this. The software program that you're probably playing, because it's the same software program that your parents were playing, if we want to fast forward that to your age 70, 7 out of 10 people are going to be living on $18,000 a year. That software program, no good. So how? All right, there's 2 steps to this. Step number 1 is about increasing your asset base. So you set a goal of how much of an asset base you need. So part 1 is, right, let's go away and get it. And you see up here on the big screen here that there are a number of different options to accumulating or increasing your asset base. The first one doesn't work, that's spending. Spending takes money away, so that's why it sits below the line. The next one is savings. Now savings will help because you get interest, but it's unlikely to be a major contributor to your wealth creation plans, and that's why the box is reasonably small. The next box along is capital appreciation, and we all know how that works. You buy an asset and it goes up in value. The problem is most people don't control how their asset goes up in value. They just buy it and hold it and hope that it's going to work out. The next box along is cash flow. So now you get capital appreciation. Damn. Capital appreciation and flow of a cash nature that increases your asset base. And then lastly, you get quick cash, which is the manufactured profit. Now, ideally, we'd all be at the far end of the screen there doing these quick cash deals and getting to our goal as quick as possible. The problem is it requires more investor sophistication as we go from savings to capital appreciation to the next one, and lastly, cash flow. Yeah. Quick cash, I meant to say. Damn, I stuffed up again. You'll see these levels of investor sophistication. Level 1, level 2, level 3, level 4. Now, investor sophistication is a tricky thing because we're not born good investors. We are made good investors, and the way that we make ourselves better investors is through education, accountability, discipline, all the boring things. Here are our options then. How do I get more money to invest with, right? It's a common question I get asked. Steve, I'd like to go and buy lots of real estate, but I just don't have enough to pay for the deposits. Because you've got to leave a deposit when you buy real estate normally. So the question we've got is, how can I get more money? Fair question to ask. Crickets. Yes. Well, option number 1 is you can work harder and longer. Let's eliminate that one. All right, option number 2, which I think is the smart option, is you can add an income accelerator. What can you add? Adam. All right, the new software program you need to download and play is called the Income Accelerator program. This is what I did. The accounting practice alone was not going to be enough to bring enough money in to go and buy real estate. I had to add an income accelerator. I had to find another way to bring money in that didn't require me to work longer or harder, as the case may be. And so the income accelerator that I enacted is a little website called PropertyInvesting.com. Any of you ever heard of that? All right, so I enacted that 10 years ago. All right, so we have this income accelerator. Now, the 3 income accelerators that you can add are an offline business, an online business, or get involved in share trading. And the reason why these are accelerators is you don't need a lot of leverage. So it's not about you working 40 hours a week. It's about you leveraging off other people in relation to offline businesses, using their time and their skill. Or in an online business, it's about leveraging the internet. Or in share trading, it's about leveraging the stock market. So you need to add an element of leverage. Let me just cut to the chase again. If your financial future depends on you working longer and harder, it's not looking good. You need to add something else into the mix. The question number 2 then is, how do I get more sophisticated? Well, here's what you need. Write these down. If you want to be more sophisticated, it starts with vision. Without a vision, the people perish, right? So your wealth creation is going to perish if you don't have some kind of vision for it. Vision is simply identifying what you want. And we've done that already in a very simple way this morning. Then what we need to do is we need to move from vision into sourcing. So we've got to find someone who's doing what you want to do. No point learning from someone who isn't doing what you want to do. Then we need to move on to education, which is getting them to train you. Once we have education, we need to move into implementation, which is finding relevant applications. And then lastly, we need to move into execution, which is taking action. So if you want to become more sophisticated, all right, in my mind, the learning threads are starting to come together, and hopefully they are in your mind as well. Realization number 1, your future needs to involve some element of change. Who's had that realization? Yep, all right, we've looked at what most people end up with and decided we don't want that. And if we don't want that, we need to do something different. What are we going to do different? We're going to add something called an income accelerator, because otherwise we're going to run out of money and we're not going to be able to buy enough real estate in order for us to go to the next level. And then after we think about income accelerator, we think, well, which one of these 3 things might be right for me, yeah? They all sound interesting, but which one do you think I need to focus on? Well, you need to figure out that, and at this conference, Tom's going to be talking about businesses, Derek's going to be talking about the internet, and Lachlan Ellsworth is going to be talking about share trading. So you'll get a chance to listen to people present their income accelerator and see if it's right for you. And if it is, then you might think, well, how do I get more educated? Who can I find who's doing it? And then how can I find a relevant application? And then lastly, what do I need to do to execute that? Now, I've got a little handout for you. Now, as you look at this sheet of paper, you might be thinking, oh my goodness, how does all this work? We start at the top, which is from 0 to financial freedom, and I want you to do 3 things. I want you to write down your annual income goal that you did for me in that box. I want you to write down the required capital base, which we've now figured out. And I want you to write down the goal date, which was the date you wanted to have that achieved by. Now, depending on the date, you have a choice. You have less than 5 years, you have between 5 and 10 years, and you have greater than 10 years. Put a tick in the time box which is relevant to you, just so that you can identify where you need to be. Less than 5 years, between 5 and 10 years, and greater than 10 years. When do you want to have achieved your income goal by? In other words, when are you going to be financially free? Have we all done that? Can I see a show of hands less than 5 years? All right, you guys are the super ambitious people I like to deal with. Between 5 and 10 years? All right, good. Greater than 10 years? All right, very good. A few people here. You've got time on your side. Let's start off with the less than 5 year people, and I'll show you how this little flowchart works. So if you want to do this in less than 5 years, unless you get paid a lot of money, you need to add an income accelerator. And in fact, figuring out your income accelerator is more important than your property investing, because you want to be bringing money in the door that you can be taken out the door buying properties. Now, moving down our screen then, after we've figured out what income accelerator we want to add, we want to try and determine whether our investing approach is passive or active. A passive investment approach is just sitting back and not putting a lot of time or effort into our investing. An active approach is, no, we're going to roll up our sleeves and we're going to dig into our property portfolio as well. We're going to make it happen. And it's more important if you've got less than 5 years to make it happen, because you can't sit around mucking around. Then we need to think about our available equity and cash. So for a minute here, let's go down. Let's say we had less than 5 years, so we've added an income accelerator, but we're a passive investor and we don't have any money. You got me so far? What does the flowchart tell you need to do? You need to go back and work on your income accelerator, because you don't have any money to invest with and you're passive. So what do you do when you've got no time and you've got no money? You apply for the pension, that's right. All right, so now let's say that you're a passive investor and you do have money. Well, you have three options. You can do generic buy and hold. You can be a money partner for someone else. Or alternatively, you can move and participate if you're interested in the fund or some other fund and just park your money there. Because you're a passive investor. You're not driving your investment. You're either going to buy it and let the market do it, you're going to give your money to someone else and let them do it for you, or you're going to jump into some form of managed fund. Starting to make sense? Now, if you go down the money partner road, you can get involved in subdivisions or renovating or developing or creative cash flow or manufactured, damn, got me again, creative flow of cash or manufactured buy and hold or generic buy and hold. But you're doing it as someone's money partner, not in your own right. All right, good. Because people, when they don't know what to do, they do nothing. And I don't want you to do nothing. I want to try and give you the tools and help you by the end of the day to have you, end of today, the wrap-up I'm going to do is, do you feel like you're starting to have a plan that's going to turn the vision into action? All right, so let's move across then to active. I just be careful of time. So if you are an active investor, less than 5 years, you've either got money, in which case you can do subdivisions or renovating or developing or creative cash flow or, I said it again, manufactured buy and hold or generic buy and hold. The sky's the limit for you. You need to pick which is the best for you. Now imagine if you could go to, I don't know, like a conference, and there are workshops on each of these things that you could go and listen and try and figure out what's the right one for you. Who'd be interested? It'd be like amazing. Now you're starting to see how this conference brings together different speakers and different topics to try and help you to connect with the right and best way for you to achieve your goal. This is the entire new software program that you're going to walk out of here on Sunday night and think, I don't want to go to work on Monday. I want to start this new software program straight away. Now, if you're, I'm spitting all over this bit of paper, you're starting to get excited. What did the duck say? Oh no. What did the duck say as she bought some new lipstick? You better put that on my bill. Only took an hour and I'm into it. Steve's found his mojo. All right, so active. If you're an active investor and you've got no money, You need to get into creative cash flow. That's how I got started. And I did vendor finance, for those of you who have no idea what that is. All right? So I bought a house and then sold it to someone else, and the money they paid me was more than the money I paid on my mortgage, and I made a surplus cash outcome that allowed me to not have to work as an accountant as hard or as long. Has anyone had an aha moment looking at this, starting to see how it's shaping up? All right, good. We're going to do between 5 and 10 years very, very quickly. Between 5 and 10 years. So, we have a little bit more time now, so we have a few more options. First of all, if you've got between 5 and 10 years, you may actually be able to achieve the goal by staying with your career. And so now we've added in a career box. Or we've also got the income accelerator box. And it may have a mixture of both. If you've got less than 5 years, you really need to be focusing on this income accelerator rather than your career. But if you've got between 5 and 10 years, you can keep your job, be happy about it. The income accelerator is gravy on the side. But you still need to choose whether you are a passive investor or an active investor. And if you're a passive investor with no money, go back to your career and your income accelerator and get some more money so you can invest with. But if you do have money, then you've got those same 3 options. You've got generic buy and hold, money partner, or get involved in like the fund that I'm setting up if that's of interest. Or if we flip to the other side for a second, if you're an active investor and you've got money, again, you've got lots of different options there. You've got to find what's the right one for you. Or again, you can get involved in creative flows of cash, or you can be someone's time partner. And if you're someone's time partner, then you use someone else's money and your time and skill, and you get involved in those deals in the middle. Lewis O'Brien, who's actually the lawyer who I used when I got started in vendor financing, on day 3 has workshops on using joint venture and money partners. So if you're in that boat, you need to get to that workshop. And then if we go to the far end very, very quickly and we look at greater than 10 years, well, you don't need to necessarily add an income accelerator at this point in time because you've got your career, and if you're a surgeon or if you're some really high-paying professional, and you're happy with your career, then you can stick with it. That's how you're going to bring a lot of money into the door. You don't need to go down the income accelerator road unless you're really bored and you want a new pet rock, then by all means. But otherwise, stick with your career and then just decide whether you're passive or active. Here's what I want you to do right now. I'm going to give you 90 seconds. I want you to identify your path on this as it is today. I want you to draw it. I want even circle it all the way down as to where you think you're going to be, how you're going to achieve your goal. And on the left-hand side there, you see income accelerators. Try, even now, guessing if you have to, circle which income accelerator you want to think you might be interested in. All right, have you found your path to financial freedom? Yep. If you found it, stand up for me. All right, good. Can we give these guys a big round of applause? Can we say, well done? All right, sit down. The people who haven't found their path to financial freedom, please stand up. I don't want you guys to feel like you missed out. All right, come on. There were more people than that didn't stand up first time around. Come on, I want to encourage you. Keep standing up. Seriously. Your job is, by the end of today, to have found that path. And if you need to talk to me or someone else about it, come and talk to me. I want to help you. Take a seat. Well done. You can achieve something that you know. It's very hard to achieve something you don't know. My objective out of this first session was to convince you that the world isn't going to end. The property market's going to ebb and flow. It's not a great time to be investing if you're a passive investor because the property market's flat, but it's a great time to be investing because you can negotiate good purchases. And as the economy and the property market recovers in years to come, as I've tried to indicate, I think it will. I don't know when. I've tried rubbing, but I still don't know the date. All right? You're in the right room at the right time. And I want you to feel excited about that. And I want you to think, yeah, wow, there's opportunity here. And if you can sense that opportunity, that the world's not going to end and acorns aren't going to fall from the sky, if you can tap into that opportunity and you've got vision, then you can do something. And if you were to meet up with me again next year and be further ahead of where you are now, then I would feel good about myself because I've tried to help you. Who would have thought an hour ago, walking into this session, you would leave with a roadmap to be financially free? Does that deserve a wow? Wow. What about a gasp of shock? Anyone hear the word cash flow? Thank you. All right, so as far as income accelerators go, I've introduced you, at least softly, to Tom Ziegler about offline businesses. Tom's going to get on in a sec. Online businesses, Derek Gill. You know, I doubt there's a man on earth who has made me more money than Derek Gill. And then Lachlan Ellsworth when it comes to share trading. Steve, there are so many choices. How do I know which one is best? They all seem good. Well, that's a fair enough question to ask. The right strategy for you is dependent on your time, your money, your interest and skill levels, and your risk tolerance. Now, these are all your investor constraints that we all need to overcome. Otherwise, we have good ideas, but we can't move forward. So how do you overcome a time constraint? The answer is you set a priority. How do you overcome a money problem? In my opinion, the answer is discipline. How do you overcome interest and skill? You get educated. And how do you overcome a risk tolerance? Is that you identify and confront your fears. The right strategy for you will require that you spend a little bit of time thinking through where you're at against your investing constraints and being realistic about it. Because if you want to do a strategy that requires more time or more skill or more money than you have, then there's no point pursuing that because you're going to fall away and you're not going to achieve success. Part one is about building your capital base however much money you need. Part two is about converting that asset base into as much income as possible. And this is where this diagram, which is in your conference books, by the way, for you to keep forever. I'll even sign it for you if you want. That was a joke, by the way. All right? The more money we have built up, the more income we can get. So this is where this diagram rounds out. If you only ever know how to spend money, congratulations, you have level 0 in your investment sophistication. Here's the good news. You've all graduated into level 0. The next one is level 1. At least you now know that there's more to life than spending money, and you have accomplished what I call is the greatest revelation in wealth creation. Let me tell it to you. Lean forward. It's a secret. Spend less than you earn. It's amazing. It works. People are trying to figure out a way where they can spend more than they earn and still be rich. And I've never come across a solution. I'll let you know if I do. Now, if you get savings, you get to level 1. Are there any level 1 investors in the room? Know how to save some money? Yep. Well, if all you did was save your money, you would have, followed all the way along to the right there, how much independent income? You'd have a small amount of independent income. Why? Because interest doesn't compound. Well, it doesn't get capital gains. Interest can compound, but it's not like a property that can go up in value at the same time as throwing off rent. If you then go down to capital appreciation, congratulations, you're a level 2 investor, and you can have a medium amount of independent income. If you can master the flow of cash, you can get to level 3, which will open up a large amount of independent income. And if you can solve those investor constraints and you are motivated to make things happen and you can tackle the quick cash, then congratulations, you can build wealth fast and move into level 4. Now, I don't know why it is, but most people nominate $100,000 a year as what they want as income. Most. Not everyone. Some people less, some people more. But you can see right now, dependent on the return that you can achieve in part 2, how much money you need in part 1. So work with me on this. What do you think, if I wanted $125,000 per annum in passive income, so this is more of a matrix than 100,000. If I wanted $125,000 a year in passive income, but I could only get a 7% return on my asset portfolio, how much in assets would I need? 1.8 rounded up $1 million. Do you see that? But if I could get a 15% return, how much would I need? And if for some amazing reason I had enough skill and expertise and you had to buy really good assets that could get me a 25% return, how much would I need? $500,000. Has anyone had an aha moment? In my opinion, people are a lot closer to financial freedom than they know. They just don't know it. It's a matter of having the right strategy and knowing how to access really good returns. And you guys are lucky because that's what this conference is all about. These are income investments. Well, fixed interest, leave your money in the bank. Where do you think you're going to be on this scale, leaving your money in the bank? Probably around the 7, maybe even less than 7. And as the interest rate decreases, you need more money invested. Then there are shares and dividends, which have some tax benefits in the form of franking credits. But again, guess what you're going to need? Probably going to need some more money because most dividends, Telstra got to 10% after franking credits once. So 10%'s okay. Then we can do direct debt-free residential property. Or we can do direct debt-free commercial property. I'm a big advocate of commercial property because $1 of commercial property is worth more than $1 of residential property because $1 of commercial property is plus outgoings, $1 of residential real estate is inclusive of outgoings. And lucky for you, there's a presenter here this weekend talking to you about how you can make commercial property work. There's a reason why I've focused on commercial property in the Passive Income USA Commercial Property Fund. Because I think that's where the smart money goes. Or you can do US tax liens. The Florida tax liens are just about over. I noticed that this year there were a stack of tax liens that weren't bought. And tax liens you can get an 18% return on. You just don't know when they're going to pay you back. Who's feeling like they're a little bit more excited now than when they walked in the door? Yep. That's not bad after an hour and a bit. I believe that you are a fundamentally positive person for you to give up a Friday and be here over this weekend. My job in this first session is really to warm you up into the world of opportunity that's at your feet and to get you reconnected back into your potential rather than your present. Because if you're like anyone else out there in economy land at the moment, you're stuck in a malaise. And there's just no time to be stuck in a malaise. So how can you control your destiny rather than someone else control your destiny? Here's what I think you need to do. Step number 1 is make a plan, because if you don't have a plan, you're a pawn in someone else's game. Number 2, set the strategy, because if you've got a plan but you don't have a strategy, you're not really doing anything, are you? And then take action. Which of those 3 things do you think is the hardest? Taking action. Throughout the rest of this weekend, when you meet someone for the first time, I want you to smile at them and say, "You look like an action taker." Can you do that for me? Can we try now? Can you look at someone and say, you look like an action taker? And the correct response to that, by the way, is, why thank you, I am. You look like an action taker too. Now this might sound stupid, almost a bit, you know, that came out. Maybe, as Christine said, maybe a bit, you know, sort of American rah, rah, rah. But the problem is, in a world where there are so few positive affirmations, let's try and make one for the weekend. Because coming from this weekend, it's about you and being an action taker that really counts. So question number 1 is, how can you control your destiny? Question number 2 is, how can you accelerate your wealth? Step number 1 is add an income accelerator. Step number 2 is select some decent assets. Step number 3 is have good strategy selection. Know how to make the most amount of money out of those assets. And step number 4 is to have active management. In regards to this conference, my challenge for you is to learn broadly. Say that with me. Learn broadly. There are going to be a number of speakers, and you're probably thinking, I'm not interested in what they've got to say. That's not really of interest to me. And you may find they're the ones who have the most revealing, interesting things for you to learn. So learn broadly. Leave your prejudices at the door. Number 2 is listen intently. Number 3 is look for the opportunity. How could I make money out of that? That's an interesting idea. How could I make money? Wow, he's talking about something there that I haven't heard of before. Where's the application? How could I make money? And then leverage your education. What do I know to make this work?